So when we get involved with businesses, we often look for some common traits of poorly managed business. And you see it sometimes by looking at the banking relationship. They bounce checks. You bounce checks when you write checks when you don't have money. That's pretty straightforward. We all know that from our personal banking accounts. Um, we cap out in our lines of credit. When we see that, or we see someone's got an operating line of credit and they're constantly right at the cap, they're not managing their money that well. Those lines of credits are designed to go in and out of. They're not designed to be a permanent loan. So when they what we call evergreen, rather than just like an oak tree, right? It gets leaves and it loses the leaves. That's how the line of credit is supposed to work. When you see covenants that people are constantly violating, when you see demand letters from customer or from vendors, when you see complaints from vendors about payment terms, when you walk around a plant sometimes and you see a bunch of inventory with dust on it. It's not a very sophisticated way to do it, but when you see dusty inventory, what we call a clue in the industry that it's not turning very quickly. And so, those are all some of the common signs of things that we see. But then, what do you do with it? Well, dusty inventory. You take a look, and sometimes somebody had a bright idea. There was a deal, so they bought 75 years worth of widgets. Well, maybe it's time to liquidate some of that stuff. And maybe you're going to take a loss on it, but right now it's a full loss. At least you can recover some cash. When you find yourself in a financial situation where you're bouncing checks, where you're up against your line of credit, that's where we start to have to say it's time to manage cash. That's an indication you're either not managing cash at all, or it's a deeper indication that you're trying to manage cash, you can't because there's real trouble, and now it's time to take a deeper dive.